Hi there, good morning. You're watching MidCap Masala on ET Now. I am Snehisha, and this is a show where we are going to be focusing on the broader end of the market, tell you everything that's happening. Nifty's taken a little bit of a tumble from the day's high, continues to be absolutely flat. 23,900 is a level that we've held on to. 23,912 is where we're at right now. The broader end, the small cap basket is doing much better, outperforming the Nifty by quite a lot. 0.6% higher, but the mid-cap index is absolutely flat with a hint of a negative bias, and that's the kind of setup that we're seeing in the broader end right now. But let's shift focus and in fact get right into the conversation with the managements from the broader end of the company. The first one that we're going to be interacting with is the management of TCI, Transport Corporation of India, on the back of their quarter four earnings, which by the way were a very good set of numbers. So let's get into conversation with Mr. Chander Agarwal, the managing director at TCI Express. Mr. Agarwal, hi morning. Thanks for your time.
Hi, morning.
Let's start by talking about your FY27 guidance. You've guided for 10 to 12% top line growth. Talk to us about what is the outlook over here and what are going to be some of the key levers that you'll be using to achieve this.
So we're projecting 10 to 15% growth top line, and that will be in line with our clients, our customers, and industry verticals that we are working with. The pharmaceuticals, the automobiles, and the solar, and all the and defense, and all the new age industries that are our clients will also be part of that growth prospect. We expect that the surface segment to be growing at a much faster rate than the previous year, and all our new products also growing in double-digit growth rates.
Okay, sounding good. And can you talk to us about when we look ahead to FY27? We've spoken about revenue, but what about your margin trajectory in FY27? And talk to us about which segments are going to be the outperformers.
So margin will also increase sequentially, and we are not seeing any disruption happening there. Even though we have the war going on and the diesel price have increased, but it's a relatively easier pass on for us, and we are not and that is also partly because we don't have a very large credit cycle. That helps in managing the cash flows quite well. The segments, again, we will be seeing that the surface cargo segment and even the air cargo segment will be a prime component for our margin expansion.
Okay, and Mr. Agarwal, when you say that it's easier to pass on the costs for you on the back of the war impact, are you talking about price hikes? Have you undertaken any?
The diesel, yes, we have already taken a few price hikes, and we are in the process also. It's a continuous process, actually. We're not doing it just one time and falling back on the existing prices. Because since we have a large customer base, we have to ensure that throughout all the new agreements and the previous agreements and all the existing agreements, we are able to increase the price, which can take time, but it's done effectively.
Being responded to well by your customers. Any slowdown in demand on the back of these price hikes?
Fortunately, that's the good part, that we have not seen any slowdown, and all the sectors that we operate in are doing quite well comparatively to last year.
So that sounds good. Let's start talking about some of your segments, Mr. Agarwal. Let's start by talking about road to rail. That is clearly gaining some traction for you. How meaningful can this become for TCI over the next 2 to 3 years, especially when DFC is ramping up?
So we're not doing a shift from road to rail. We are providing an additional service in the rail cargo. So it's like of course the task would be to have an integrated service of the road and the rail, but that's again a humongous challenge in India with the infrastructure missing and all the DFC not able to connect the faraway locations to the rail network. But I see that the real DFC benefit will come for the exports. where the containers which take about almost 2 weeks to go from North to West India will substantially reduce by a week. So hopefully that is going to be the saving grace of the DFC, and not so much as a comparison or a substitution for the road network.
Okay, and speaking of the seaways segment, that's been a strong performer for you yet again. And also on the broader macro impact, or the macro front rather, with coastal shipping getting policy support now, how big can this seaways segment become for you in the next few years, and what part of your overall revenue mix can come from here?
That again will be subject to the authorities. I mean the shipping ministry, what they are able to prospect us in terms of the benefits, like a zero tax, or the foreign vessels not able to apply. So all of these factors will determine how the industry will shape up. And of course, the business is subject to how many more vessels we add, and that will be that is an ongoing process.
And on that, Mr. Agarwal, in terms of your vessel addition, your capex is also stepping up meaningfully, including ships and network expansion. Talk to us about what the capex plans for FY27 look like, and what kind of return thresholds are you targeting on these investments?
We are looking at, I mean, in a broader term, through internal capex and borrowing, we probably, for TCI Express, actually, we will not be borrowing, but it'll be all through internal accruals, an investment of close to almost 120 crores. And that will be done on, the network, as you mentioned, and getting of new sorting centers and creation of new sorting centers and automation. And of course, technology will be playing an important role in this investment as well.
Okay. And Mr. Agarwal, going ahead, do you see operating leverage kicking in as your volumes rise, or do you believe that competitive pricing will keep your margins range bound? Given the kind of competition that we're seeing brewing in the sector, especially on the freight front, what's your outlook there?
So we always have a leverage on the OPEX because we don't own any assets. We don't own any trucks. So therefore, it's easier to kind of scale up and scale down depending on demand. And like that, we are seeing that definitely a 1 or 2% increase in EBITDA margins, and we would like to take it up back to the levels that we were earlier at.
Okay, so understood and point taken very well. Thank you so much, Mr. Agarwal, for your time. It's been good interacting with you. Congratulations on the quarter that you've seen, and good luck for the quarters to come. On that note, viewers, it's time to slip into a very short break on this edition of MidCap Masala. More conversations lined up on the other side. Stay tuned and we'll be right back.